What's going on, YouTube? I'm Mike with Penner Investments, and today is going to be part one of a two-part series of my most profitable strategy. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Well, let's dive in. What I like most about this strategy is that it brings in consistent cash, allows me to lower my basis in the stocks, and adds more shares to my overall portfolio. The option strategy is selling cash secured puts. Selling options is the most profitable and consistent option strategy that I've ever found. I only use this strategy on rock solid companies that I plan on investing in for many years to come. I do not invest in companies that I have to worry about going bankrupt and losing 100% of my investment. A few of the companies I like are big name companies like Apple, Microsoft, your Bank of Americas, NVIDIA, and exchange traded funds like the SPY and the Qs, the QQQ. Just a refresher to keep in mind with options is every options contract is for 100 shares of stock. Selling a put option gives the holder of the option the right at any time to put 100 shares of stock to you at the strike price at any time that the stock drops below that strike price. The reason someone would buy a put option is for insurance or to speculate. Say I own 100 shares of NVIDIA and the stock is trading at the $145 mark. 100 shares would represent $14,500. If I was concerned about the stock going down in the short term but I don't want to sell out my shares, I could buy an NVIDIA put options contract for $600 with a strike price of $140, expiring on January 27th of 2023. If NVIDIA were to drop down to the $130 a share, the holder of the option can do one of two things. They can sell the option as the put option has risen in value since the stock price has fallen below the strike price, or they could exercise the option and sell their 100 shares at the $140, which was the strike price of the option, even though the stock is trading at $130 a share. The reason I like to be seller of these options contracts is that many times I can sell these contracts each month and the stock does not drop below the strike price, which means I just keep the $600 option premium and use that to reinvest in my portfolio. I may do this for several months before I ever get assigned with 100 shares of stock. When I do get assigned, I'm happy to own the stock as I only do the strategy on solid companies that I'd want to own over the long term. The setup for this strategy is pretty simple. I do not trade over earnings, and I'm looking out to the closest day to expiration that is 30 days out to expiration. I'm also picking a strike price that pays a premium of at least 2% of the capital at risk. So if the strike price was $130, this would be a total of $13,000 I'd be putting at risk. I'd want to get a minimum of $2.60 premium, which for 100 shares, remember options are all for 100 shares, it'd be $260. If we look at the options chain right here for NVIDIA, we can see for the $130 strike, it is paying $305 per contract, which is well above the 2%, so I'd be happy to make this trade right here. Well, I hope this has been helpful, and be sure to check back next week for part two. And as always, thanks for watching, and if there's ever anything you'd like to learn more about, please drop a comment in the comment box below. Good luck trading.